Ever wondered what pips, lots, leverage, and margin mean in the world of Forex trading? The world of Forex can seem like a maze of jargon and acronyms. But fear not, this video will break down these terms, explaining them in simple, easy-to-understand language. First up, pips. A pip is an acronym for point in percentage. It's a unit of measure for currency movement in Forex trading and represents the smallest price move that a given exchange rate can make. Think of it as the smallest increment of change in a currency pair price. Next, we delve into lots. In Forex trading, a lot refers to the size of a trade. It's essentially the number of currency units you will buy or sell. The standard size for a lot is 100,000 units of currency, but there are also mini, micro, and nano lot sizes. Moving on to leverage. This might sound like a physical effort, but in Forex trading, it's all about financial power. Leverage is a strategy that can multiply your profits, but it can also amplify your losses. It allows traders to control a large amount of money using none or very little of their own money and borrowing the rest. Finally, let's tackle margin. Margin in Forex trading is the amount of money needed in your account to maintain an open position. It's like a collateral or a deposit required to open and maintain a position. In summary, pips are the smallest price move a currency can make. Lots represent the size of your trade. Leverage is a double-edged sword that can boost your profits or magnify your losses. And margin is the money needed in your account to keep your position open. Understanding these terms is a stepping stone to becoming a successful Forex trader. They are the fundamental language of the Forex market, and grasping them can help you navigate the complex world of Forex trading with more confidence and precision. Remember, knowledge is power. Equip yourself with the right knowledge and you're already on the path to success. Happy trading!